that. So I don't have like some exorbitant amount of wealth or anything like that, but I recognize the amount of wealth that I have relative to the world, and that makes me rich. I would say I'm rich in the scheme of the world. And so that's how I identify rich, and you don't have to identify that way, but that's the only way I'll ever feel rich, because otherwise I can keep comparing myself to more and more successful people, and relative to them, I'm not rich, right? And so I can make myself feel poor if I want to, or I can make myself feel rich. And so it's really all about what you do in up here is how you feel rich. It's all in your head.
Hello and welcome everyone. I am Vishal Khandelwal and I welcome you to this new episode of the 1% Show. This show is an open-ended exploration into the minds of the wisest people around to help us learn to think, invest and live each day a little better. You can learn more at vishalkhandelwal.com. My guest today is Nick Maggiulli, the creator of Dollars and Data and the Chief Operating Officer at Ritholtz Wealth Management. Nick is also the author of a new book titled Just Keep Buying, where he crunches numbers to answer the biggest questions in personal finance and investing, while providing the reader with proven ways to build wealth the right way. Nick started as a blogger in 2017 when he started writing one blog post a week as a New Year's resolution. He says, and I quote, "It's the only New Year resolution I've ever kept. I just kept writing." Anyways, with this and no further delay, Nick, welcome to the 1% Show. Thank you for agreeing to do this and for keeping that New Year resolution for writing every week, for that has certainly contributed in making the financial world a better place.
I truly appreciate that, Vishal. Thank you.
You're welcome, Nick. So to start with, Nick, just tell us about your life and background and the most important dots you connect in your past that has made the person you are today. And also, my second question, what's your North Star or your driving force in life?
So first answer the first part of the question. I was an economics major in college. Right after I graduated out of school, I joined something called economics consulting, which or some may know as litigation consulting. But in the process of doing that, where we're consulting for big clients who are hiring law firms, I did a lot of data analysis. So I really learned how to get my data chops, my technical skills, learned how to use GitHub, things like that. Right, R, a lot of programming. And as a result of doing that, kind of got really into data analysis. And so I kind of was just like always into that. But at the same time, I knew like I really love personal finance and investing. And so I said, hey, this is like really where my heart is, even though I love data, but I also love this as well. And so I was like, you know what, I'm going to start blogging. So as you know, as you mentioned at the beginning, started blogging once a week. That became a Dollars and Data, where I'm still going. I'm about to be on, I think next week's like number 299, post 299. So we're almost at 300. So it's almost 300 weeks now in a row. It's been a lot of that. I mean, some weeks I do more than one, but generally it's been one a week. And in addition to that, just been doing that. And at some point during COVID, beginning of 2021, I said, you know what, like we're going to be trapped inside. I thought we were going to be trapped inside for years. I was like, this is, because it was like a year, almost 6-8 months after everything started. And I was like, we're still in, like, we're going to be in this forever. So I'm like, might as well use this time. So, took every weekend, just put together some old work, some new work, put it all together into like a book format and came out with Just Keep Buying. And just been doing that since. And I'm just marketing it. So North Star, I really believe in like evidence-based, research, and whether that means using evidence to like change your life, self-improvement, whether, everything's about trying to find the truth. At the end of the day, that's all we want to do. And sometimes it's difficult, when there's a lot of variables, a lot of things like, I think things like, investing in health can be really difficult because there's a lot of moving parts. There's a lot of factors in all of these things in our lives, right? When it's usually easy, there's usually no debates, right? Like I don't think there's a debate right now, a real substantive debate about whether smoking is good for health. I think people agree that long-term smoking is generally not good for health. Smoking one cigarette every couple months is probably no big deal, but doing like a pack a day for 50, 60 years is probably not good for you, right? If you'll even last that long, right? So I think it's about figuring out where are these debates happening, why are they happening, and trying to find truth if we can, within the data and whatever's out there. So I say that's like my North Star of like what I try to do, regardless of what I'm analyzing, whether I'm analyzing, investing, personal finance, or if I were to analyze health or something else, some other area, I would use that same kind of guiding North Star there.
That's great. So you've been blogging like for the past 5 years now, and almost like relentlessly. You've written almost one post per week as per your plan. Before we move on to your ideas on money and investing in personal finance, I have a question on blogging. right?
Mm-hmm.
I'm sure being a writer and writing so frequently, right? I'm sure there are lessons that you must have learned from your journey as a blogger and writer and now an author. So tell us about the biggest lessons learned over there.
I mean, specifically as a writer, I can only say as a writer. I can't say as like a general content creator, like someone who does video or TikTok or any of that. I don't really know what that's like, but I can say as a writer, the biggest thing is just like reading a lot. Like, because your brain is like this very unique idea machine. Like your brain is very different from mine, very different from every listener listening to this podcast right now, right, or watching this podcast. And so when you and I get the same information, we might come to different conclusions. We might, oh, this connects with this other thing. And so maybe I'll connect it with one idea and you'll connect it with a different idea. I think a lot of times people think they have to come up with brand new ideas all the time. And a lot of it is just about how you pitch it, how you frame it, the perspective. And when you can just kind of reframe something, you can kind of really kind of build a following. You can get, people to like your work, things like that, and really kind of help people. And so that's why I think a lot of my stuff is not brand. I mean, I didn't come up with dollar cost averaging, obviously. Like it's a big proponent I have in my investment philosophy, but it's like, how did I talk about dollar cost averaging that was different from everyone else? And what I've done, I've used data, I've used simulations, I've done a lot of things that I haven't seen done previously. And so that's where I think I'm adding value. It's like my data science background coupled with all the stuff I've read and things like that. So just that's the one thing I'd say is like read a lot. Your perspective is what's important, and trying to provide a unique perspective is what's important. And if you don't think you have a unique perspective on something, then just don't write about that. Write about something else, Like I don't have a great perspective on budgeting, to be honest with you. I don't think I can add a lot of value there, but there are other areas where I do think I add a lot of value. So that's kind of, my take on it is if you're going to do that in the writing sense, just, try to be consistent, try to find a time when you can do it, and, just keep going every week. Even if sometimes you don't, you're not absolutely thrilled with everything you put out. As long as you feel like it's decent quality, it's got to be above a certain bar, then just put it out and kind of wait, because at the end of the day, the last thing I'll say on this is most people don't remember your failures. They only remember your victories. So like all of my posts, like I have a decent sized audience, but like most people probably couldn't name more than 2 or 3 posts at most, right? If that, but everyone has to remember, I remember Nick wrote this post about this thing or that thing. And for every person, it's different. Some people remember a post I wrote on alcohol. Some remember a post I wrote on social anxiety. Some remember a post I wrote on investing, like, dollar cost averaging or market timing or whatever. Everyone remembers different stuff. So it's really just about kind of casting a wide net, kind of putting yourself out there and seeing what hits and what doesn't.
Yeah, I completely agree. So I have been writing a blog myself for the past 11 years now, almost more than that, right? Written more than 1,000 articles, right? Most of the time, it's like reframing what has already been said by someone else, right? And trying to bring the gist down or try to bring the most important points down to the reader, right? And again, hoping that that idea or that thing which I'm talking about, right, which has obviously been said by so many other people, right, but it touches the right kind of people or that one person who needs that at that point of time, right? So I think that really gives you that motivation to keep writing. Though I started by writing almost daily, right? Unlike you, who had that resolution of writing once a week, I started writing really just to show up every day, just to get into that practice of showing up every day and sharing whatever I had learned or whatever I was learning with the audience or whatever little number of audience that I had. But it has been a journey worth it, right? So and as you said, right, there are some posts that there are very few posts that you, even when you write, yeah, you remember the kind of work that you did in your journey in the past, right? So I have been reading your posts for quite some time and love almost all of them, right? But recently I read a post where you wrote about kindness, right? So I think the title was "Revenge is Easy, Kindness is Hard." And you wrote in that post how once you got 2 of your work colleagues fired because they had not dealt with you well, and how you later came to regret that. So tell us about that story and why you think kindness, despite being hard, is such an important responsibility we have while dealing with one another, and especially in an age of social media when it's so easy to be unkind.
Yeah, of course. So in that particular case, I said work colleagues. They weren't like employees of our firm. They were most like outside contractors, basically like a third party contractor. And they were doing some like website development for us. But I came in and I was supposed to manage the project, but they wouldn't answer to me. Like I had to Slack them and wait for them to kind of get back to me. And they took them all, and they had day jobs, right? So this was really a side thing for them. But a lot of times they just took so long to get back. Sometimes, days. Most days it took many, many hours for them to get back to me. Sometimes it took days, right? And I was like, but if I need something urgently, it didn't change anything, right? And so, I got very upset with them over the course of them basically ignoring me. Yet every time my boss reached out to them, they responded like almost instantly. And I was like, what's going on? Like they're obviously, I didn't think they respected my title. I got offended by that. I got upset. long story short, I basically like, I'm going to just take their jobs because I'm going to learn how to do what they do. So I spent, a lot of time, couple weeks, just all my time was spent just learning web development. Web development is not too difficult, especially if you have a little bit of a programming background. So I learned the basics of HTML, CSS, WordPress, all that stuff. I basically told my boss, like, hey, I can do this now. We don't need to hire these people and pay them. And he's like, prove it. So I was like, showed him all the stuff. And he's like, okay, cool. I trust you. And then that was it. We fired them. And I was like, and then all of a sudden now they're calling my phone. Now they want to talk to me and all this. Right. And so, at the time I was very happy when that happened. I'm not going to lie. It was a very sweet revenge. But looking back, I just thought I could have dealt with it with more grace and not have been so vengeful towards them. And I understand that feeling. And even there's times when people say stuff to you online that's rude or something, and it's easy to dunk. And I've done that. I've done this for years. Trust me. I've gotten a lot of points on Twitter by dunking on people and disproving their arguments and stuff. But, the more I've done this, I've just realized, like, I don't really want to do that anymore. I don't want to be associated as the guy who just dunks on people. And while it's easy to do it, and while it does gain you points and people laugh and this and that, whatever, it's like, I don't want to be that person. Like, I'd rather just say, hey, I'm going to speak my truth. And I think the evidence will win out. And if you believe me, that's fine. If you want to listen to other people, that's fine too. Like, it's up to you. Everyone has to make their decisions. I'm not here to if someone attacks me, that's very different. I would defend myself. But besides something like that, I will never try to dunk on someone ever again, no matter how wrong the argument is. I just don't try to do that anymore. So I'm just the reason I really focus on kindness, because I think, social media is very dehumanizing. Like, imagine we were in a bar instead of actually being like all through social media, and someone said something, like, people would not say a tenth of the stuff they say in real life than what they say on social media. Right. And so, especially anonymous people say truly some horrific things. So I'm just like, would I say this in real life to this person? Would I make a speech? Imagine I'm at the bar and you were giving a talk, right? Or we were just at a presentation or a conference and you're giving a talk, and I go up while you're talking, and this is my quote tweet. I walk up and I say all this stuff, and I dunk on you. Like, it would be inappropriate in that setting. Even if I didn't agree with you, I might ask a question and say, hey, do you think that this could be wrong because of this? Like, maybe that's like a reply, but a quote to is like me going up while you're talking and then me saying something over, And so I just don't think I would do that. And I'm just trying to get people to be kinder, because I see how bad and how divisive it can be. And it's something I'm learning. I'm getting older, I'm getting more mature. When you're young and you're in your 20s, you're trying to prove yourself. It's very different, once you kind of have an audience and stuff. Now I don't feel like I need to prove myself in the way that when I was younger, I feel like I had to go out there and fight for my piece of the space, right? So that might be a piece of it as well. So I'm saying this as someone who's kind of won that game already, so I don't need to play it, right? It's kind of a very different take, but I still think you can be kind and still kind of grow your audience without that. I don't think I needed to do that to kind of get whatever street cred or whatever you want to call it in credibility within the investment space.
Well, that's right. I think life is a struggle for almost every one of us, right? And we are not really sure about where the other person is coming from. So I think it's a responsibility that we be kind to each other, especially when we don't know what the other person may be going through, even whatever they or he or she may be looking like on social media. So I think fair enough, your point, well taken over there. Talking about another of your posts, I think one of the first from the recent post on kindness, one of your first initial posts that you wrote on your blog was about the idea of following one's passion. And you suggested why it was a bad idea if one's passion is in an industry with a wide distribution of economic outcomes. Now, I see a lot of people, especially post-COVID, quitting their jobs to follow their passions. Some I know have done really well in that, while most have struggled and are rethinking getting a job again. So tell us about your idea of when should one follow his or her passion and when should one not, especially considering the financial aspect of it.
Yeah. So if you're looking at the financial aspects of, following your passion or something like that, you have to look at what's the distribution of outcomes. For example, let's say you want to be a singer or songwriter or an actor or actress or something like that. Those are cases where there's a very, very wide tail, right? There's a long tail that sits out there, which means a very small number of people get very famous and take most of the winnings, right? And name a C or D list actor. They're very difficult to name, actor, actress. Or same with a singer songwriter. It's where the victor go the spoil, so to speak. That's not true with something like being a dentist or being a lawyer. Of course, there are some lawyers that are incredibly popular, famous, all that, but most lawyers probably the average wage or the median wage is still decently high. And so I'm not saying not to follow your passion at all. If you want to do it, that's fine. You can do it on the side. And for example, even when I'm very passionate about investing in personal finance, but it's not while my main hustle, my main job is related to it, I work in an investment management firm. I still have a job. I still have a job where I want to do 40 hours a week. I have no plans to be leaving that company or doing anything like that. I believe in the mission. I like working there. I like working with people. I don't think I would enjoy working by myself all day. So that's one piece of it. And I just don't think I'd want to be a full-time content creator. That's not who I am, right? At least not now. Maybe one day that'll change, but for now, that's not true. So I think if you want to follow your passion and do that, you can. It's just a matter of like, don't make it your entire main hustle. Maybe you have to do your side hustle. Maybe if it takes too much time and it's really starting to succeed, then of course you can leave your job and do that if you want. But I think you should just do it as a side thing. That's what I do. I still do to this day. I'm doing that thing. And I'm trying to be an example showing how you can do this without having to risk your financial life to follow something you care about. Because if you really care about it, you'll make time. You're like, but Nick, I don't have enough time to do it. Make the time. I don't know. I put in 10 hours a week for, almost 300 weeks now. So like, we can find excuses, of course. And like, yes, if you have a family, it's tougher. If you have other obligations, it's tougher. I'm not going to lie. But if you can give 5 to 10 hours a week to something, I think you can still build something. I think it's definitely possible. It just takes a long time. Like for 3 years, I didn't make any money on my blog, $0. Now I run ads, so I make some money. So it's nice to have a little bit of extra income, but it's not like I can live off of that, So just being realistic about what to expect. And so, I'm not against people following their passion. I'm just saying like, hey, if you're going to just be reasonable about it. It's a very early post too. It was very early type thinking. I've become a clear thinker. I rewrote that post to be a little different today. I don't disagree with it, but I don't agree with it as much as I did then.
I think, yeah. So I receive a lot of questions from people wanting to quit their jobs and become full-time investors. And in most cases, almost 99% of cases, I just tell them that this is not a good idea. Mostly, right? Because when you are, first thing is investing is not a full-time activity. The better you want to be at it, right? The less amount of time you want to spend on it, right? Second thing is the kind of behavioral attributes that you need to become an investor and base your entire life and living on investing. I think that's a different ball game altogether compared to using it as a part-time tool or a process to create wealth for yourself while working on something else where you're saving money and putting that money to work, right? So different way of thinking altogether, and the kind of risks, the kind of stress that a full-time investing, I think, brings on, right? Both financial and emotional, I think that's a different thing altogether. So I think I completely agree, or almost completely agree with your idea about looking at professions where the outcomes are not too wide, right? And then considering whether you really want to follow that as a passion or a full-time activity or not, right? So that's great advice. I want to now talk to you about your book. I read your book. Thanks for sending it. It's a wonderful book. Just Keep Buying, right? So tell us about the basic premise of the book and what is the big idea that you want to promote by writing it?
Yeah, the big idea I want to promote is that there's a lot of beliefs in the personal finance and investing space that just aren't true. Once you actually look into the data, you realize they're not true. And so they're just like told to people, they make intuitive sense, but they actually don't hold up once you look under the data and evidence out there. And so the book's called Just Keep Buying, Proven Ways to Save Money and Build Your Wealth. And no, it's not just about dollar cost averaging. Of course, that's a core tenet I have, right? Like if I'd only give you 3 words, I would say just keep buying, right? As an investing idea, like that's like my core. And then if I'd like give you a sentence, I would say the continual purchase of a diverse set of income producing assets, which is mentioned in the book. That's like the mantra, right? So that's what I would give you if I had a sentence. But obviously, there's a lot more than just that. That's like one piece of your journey. Really, the book is laid out. The very first chapter is called Savings for the Poor and Investing for the Rich. I know we're going to talk about that later. But basically, that first chapter lays out, this like saving versus investing continuum, and that whole idea there, and like where you are in your journey is based on kind of, how much can you save versus how much can your investments earn you. And based on those numbers, it tells you where to focus and kind of where you are on your journey. And so I think that's the real kind of core structure of the entire book, and kind of why I wrote it was like, hey, I want to disprove a lot of stuff out there in the personal finance and investing space, but I want to also give you a framework you can use throughout your life to say, hey, if I'm here, I need to focus on these areas, right? Like, for example, tax optimization in your investment portfolio is, at least in the United States, that's not something you have to worry about when you're 22 or 23. You probably don't have a lot of money invested, so it's not going to matter. But once you're 65, 70, I bet your taxes matter a lot more, right? So it's like you can see how the relative importance of certain things is going to change over time. And that's kind of how the book is structured. It's like laid out in saving to investing, right? And that's the early chapter saving, the later chapter investing. And so I basically am like, hey, figure out where you are and then focus on those areas and try and optimize that instead of spending time on everything all the time and being neurotic about it,
You've been in this industry, personal finance, for a few years now, right? And you've also covered a lot of stuff in your book, right? We are going to talk about that. But tell me, what are the biggest lies that you see floating around as far as personal finance is concerned that people have been fed all these years, which you think are lies, and people should really look over them if they want to improve their personal financial lives? So the biggest lies in personal finance.
Yeah. So the biggest lie, of course, is that cutting spending is a long-term sustainable way to build wealth. And I don't think it is. I mean, you can do stuff in the short term and that helps, but most people that have built wealth over the long term, you look at, look at the statistics, look at the data on how people are actually building wealth. Most of them have higher incomes. It's income. It's mostly income that's driving. And the reason is simple. Like, what's the most positively correlated thing with savings rate across the board? It's income. People with higher income generally save more than people lower income. Now, of course, you'll probably know someone. Oh, I know someone that only made 50 grand a year and they're a multimillionaire. It's like because they only spent 10 grand a year or something, right? So there are exceptions to this rule, but they are exceptions, right? Like if you actually look at the bulk of people, like most people are not living like that. Most people are living in a way such that as their income goes up, their spending does go up, but it doesn't go up as quickly. And so on average, that difference kind of diverges, and that divergence is savings, right? That becomes savings. If your income is growing faster than your spending, you're going to end up saving more of that money by definition, right? So I think that's one of the biggest lies, is that cutting spending is a way to build wealth. It isn't. You got to build your income. Another big lie, at least in the United States, is that there's this massive retirement crisis. I hear about all the time. For years, I heard about it. Look at the data; it's just not there. I mean, there's only 1 in 7 retirees are selling down their principal in retirement. Most of them are just living off their dividends and their investment gains, and what in the United States, Social Security. So I don't see that as being an issue. That's another thing. Another one that's also United States based is max out your 401ks. Like, stick as much money as you can into these non-taxable accounts. And in certain cases, I do support certain types of non-taxable accounts. I think 401ks are an exception because everything beyond this thing called an employer match, anything beyond that. And I just think you're locking your money up, and there's no flexibility, and there could be high fees. There's a bunch of issues there. And I kind of get all into these in the book, but there's a host of different things. And then market timing. There's a lot of lies around market timing. You should buy the dip. You should do this. You should wait in cash, like all that type of stuff, which I don't agree with. And I kind of debate and dig into within the book in such a way that I think it's like definitive that like any sort of timing strategies just don't really work.
I agree over there as well. Though I remember a quote, I think from Seneca, who said that the poor are those not who have less, but those who want more, right? Keep wanting more. So, but I think going by your idea of increasing income, I think that's something that most of us have not been told by financial advisors or the financial service industry. We've all focused on paying yourself first, or saving as much as possible, which is a very valuable price, especially for youngsters, right? Save as much as you can. But I think over a period of time, it's also about growing your income. I can relate that to analyzing businesses, analyzing stocks, right? So one way of looking at businesses and thinking that or wishing that they could increase their profit margins is by looking at how they are managing their costs, right? Cost of operation. So a business can only increase margins up to a certain level by reducing cost, but after a certain point, the business also needs to grow business or grow revenue or grow income, right? If it really wants to become more profitable and return more money to shareholders. So I think growing income is slightly underrated. Not many people talk about it, but thank you for focusing on this subject in your book. And I'm sure there are a lot of insights over there for people. You start your book with the statement, which I quote, when I was 23 years old, I thought I knew the answer to building wealth. Keep your fees low, diversify, hold for the long term. I had heard this kind of advice many times from investing legends such as Warren Buffett, William Bernstein, and the late Jack Bogle. Now, while this advice was not incorrect, it made me focus on all the wrong things financially as a recent college graduate. So tell us more about that. What's wrong in the above advice, and what were the wrong things you were focusing on while following this advice early in your life?
Yeah, it's not that the advice was wrong. The advice is accurate. It's correct. It's actually good advice. The issue is when you're 23, that the return on that advice is very small. It's going to be later in life. That advice is incredibly useful, especially as you have more money invested, right? But when you're 23 years old or when you're very young, most people don't have a lot of money when they start working. Of course, there's exceptions to this rule, trust fund kids, whatever, but most people don't have a lot of money when they start working, when they get out of college or when they just got out of high school and they start working. And because you don't have a lot of money invested, especially the returns to that advice are small, right? And so what's really going to hit the bottom line for you, as I said, it's going to be your income. It's going to be your career. So in the first decade of you being out of school, whether that's high school, college, whatever, it's going to be your career and your earnings. And what can you do with your earnings? That's how you're going to start getting money so you can invest, right? I think people don't realize that. It's like the reason I was able to build wealth was because I came out of school and had a decent income, just coming straight out of college, right? And I worked hard and I, got better. My pay went up and I was saving a lot. And so all that type of stuff because I had income, right? It wasn't, I knew all the advice. I knew all those things. Like that thing I learned that you just quoted, I've known that since I was 22, 23 years old, And the issue is it wasn't that useful early on just because I just didn't have a lot of money. And now it's far more useful for me to follow that because I have more money invested, right? So it's the same thing. You should see that in your life. So I'm not saying it's not good advice. It's just the advice wasn't right for the time. It was like I needed to wait to use that advice. Of course, you should use it early. You should keep your fees low. All that stuff's accurate, right? You should buy and hold, all that type of stuff, right? That's all correct. It's just I was obsessing over it. I was like, oh, I just need to do this. And I was like, no, what I should have done is focus more on my income because that would have driven more to the bottom line, which would then allowed me to use that advice, right? So that's all it is. It's just about figuring out where you're focusing your attention.
In one of the lessons in your book is about not buying stocks, right? And you, I think, quote a story about your friend who bet on I think GameStop and lost a lot of money. The money that he made quickly, he lost as well. He lost probably more than that. And you also advise that most people should not be investing in the stock market. I agree with that, right? People speculate, people trade despite whatever financial literacy we try to spread, right? Despite everything that we want to teach people about the benefits of long-term investing, dollar cost averaging, right? People still speculate and lose a lot of money in the stock markets. But wasn't your advice more applicable to people who speculate, or is it for generally everyone who's retail that your advice is that they should be investing in index funds and not picking stocks? So I agree that not picking stocks is not a shame, like most people think, and you are still fine not picking stocks, investing in mutual funds and index funds. But what's your point over there about picking stocks versus index fund for most people out there?
Yeah, so my argument was against picking individual stocks regardless. Now, of course, I started with the story of GameStop because it was an entertaining story. I don't think GameStop is the perfect example of why people shouldn't pick stocks. It's not. It really isn't. It's always very high speculation. Of course, I understand that. I understand it's very different than analyzing companies, looking at a balance sheet, doing your homework. I understand that. That's not what I was trying to say. And so there's a lot of people I've heard things back like, oh, you're saying GameStop's the reason that you shouldn't pick stocks. Like, no, of course not. That was just a cool story. It happened in the course of 2 hours. And I got a lot of the emotions that you're going to get over years. You imagine that over years happening. And I just got it in a 2-hour window, which is kind of cool. It's very rare. You can kind of have all that time dilation in a way. And you kind of get a full stock picker's experience in the course of 2 hours, right? But I still, despite that, I don't think people should be doing all that research, picking stocks and all that. Why? And so I talk about the financial part of it, which people have heard before. You're probably not going to beat the index fund. Okay. Some people want to do it for fun. I say that's fine. I say that near the end of the chapter. It's fine if you want to do it for fun, do it with friends, whatever, but keep it a small percentage of your portfolio. That's what I say. Be prudent with your risk management. But my real argument is, how do you know if you're good at doing this? Like, and you're like, it's not like in most endeavors in life, we usually can identify skill pretty quickly, right? You go into a basketball court, you play against LeBron James. It's pretty obvious you're not going to beat LeBron James, right? You go and, you have to write a computer program. And if the program doesn't work, you're not a good computer programmer. Maybe you can learn that later, but the feedback loop is small between what you do and when you get the result is small in basketball. It's small in computer programming. It's small in so many things. With investing, the feedback loop could be a year, 5 years, 10 years, usually within 5 years, at least that's the feedback loop. But what happens if you picked all the best stocks and then we go into a 5-year bear market? Like those stocks could still be up a little, but like you didn't earn that much. Maybe the market's down more. You've beaten the market on a relative basis, but you still didn't earn money, right? And so I think a lot of that is luck, and it really goes to show. I think one of my favorite stats is that if you had beaten the market by 5% a year from 1960 to 1980, you would have earned less money than if you had underperformed the market from 1980 to 2000 in the United States stock market. Why is that? Because the returns from 1980 to 2000 in the US stock market were so high that even underperforming by 5%, you still would have outperformed someone who outperformed the market from 1960 to 1980, right? It's just because that's luck. That's like beta, and that stuff matters. And so because there's so much luck in the stock market, it's really tough for me to be like, oh yeah, you should go pick individual stocks, because at the end of the day, you're not going to know if you're good for at least a decade. And how many times are you going to spend a decade of your life working on something week after week, not knowing if you're getting a return, right? And this is something you even kind of spoke about earlier. It's like, is that the best use of your time? And like, I don't know. And so I think most people were not meant to be stock pickers. And so because of that, I'm like, find what you're actually good at, where you have identifiable skill. Like, you can obviously say, look, I can do this, right? I have skill doing this, and focus on those things and just add value that way. Because you're going to make more money, and then you're going to put more money in the stock market. You're going to earn more on a return on your hours spent than you would, from your investments, right? And especially if you don't have a lot of money invested either, it's even worse. Like, let's say you have $10,000 invested, right? US. Okay. And you expect a 10% return. Okay. What would that be? That'd be $1,000 in a year. Okay. But let's say you can double that to 20%. That's great. Obviously, if you're managing $1 billion, that's incredible, right? But if you're only managing 10 grand and you double it to, that's an extra $1,000. But how many hours did it take you to do that? Let's say it took you 100 hours to do that, or 500 hours to do that, to get that extra 10%. What is that worth? You spend 500 hours for $1,000. That's $2 an hour. Like, you should have got a second job doing something else, right? Like, you see the point. Like, the return on your time is what's important too. So I think there's a lot of factors here why people shouldn't do individual stock picking, and I kind of get into those a little bit. But yeah, GME is just a crazy example. It's a fun example, but it's not the reason. The main reason is just you don't know if you're good, and I don't think people should be spending a lot of time there.
Mm-hmm. You mentioned about luck. I think most people get into problem in investing because they deny the existence of luck in their investing life, despite the fact that there have been studies done for years. Michael Mauboussin has written a wonderful book, The Success Equation, where he's proved, I think, using data, why investing is largely a game of luck, right? But as per your research, as per your study over the years in personal finance investing, I'm sure you must have identified ways one can mitigate bad luck as an investor, right? After all, investing is not just about the cards we are dealt, but also how we play our hand, right? So what, according to you, can an investor do to mitigate bad luck on his or her investment performance?
Yeah, there's always things you can do. I think risk management is a big piece of that. So like figuring out how you control your risk. Secondly, there's always options you can do with your spending. So remember, I said spending is not a long-term path to building wealth, but if you can control your spending, let's say there's a big drawdown or something bad's happening in the market, and if you're retired or something, and you're going to have to pull money out. If you can lower your spending temporarily just to get through a tough time, that can add a lot of value, because now you're not pulling down more money when you have to sell already at depressed prices. You may not want to do that, right? So if you can kind of tough it out for a year or two with, lowering your spending, that can help out a lot, right? That's another example. There's also stuff you can do with asset allocation, which is kind of related to risk, but like there's having emergency cash, right? Having an extra emergency cash. And some people only have 3 months, maybe you have 6 months or 12 months, whatever. Everyone does things differently, right? I know some people that, I think Morgan Housel is like 25% cash. Some people, I would never be that much. I think that's a little much, but that's risk management. Like Morgan Housel is not ever going to have to worry about money because he's 25% cash. Like he's never going to be like, oh my gosh, something happened and now I don't know what to do. It's like he's going to have that risk management that me and many others may not have, right? So that's something to think about, right? And he said this publicly. This is not private information. So it's one of those things where you think about that and you think about like, okay, what are the things you care about and how can you kind of mitigate bad luck? And that's how you do it. You have to have some sort of risk management. There's ways you can be flexible in spending and how you make personal finance decisions. Those are two of the big ones I'd point out.
That's a great point. Another interesting point you make in your book is that people never feel rich, how much ever financial wealth they have accumulated. I think that took me to John Bogle's idea of having enough, right? Having enough money. Right? And I think that's not surprising, though, given that I believe that money cannot buy everlasting happiness. But what exactly do you mean when you write that people never feel rich?
I think what we see, at least in the data, is that as people kind of gain more wealth, they end up going into higher social circles with other wealthier people, and they always can point to someone who's richer. And the story I give in the book is from Lloyd Blankfein, who's the ex-CEO of Goldman Sachs, and he was being interviewed. And remember, Lloyd's a billionaire, and he was being interviewed, and he said, "Oh, I'm not rich. I'm just well-to-do." This is a billionaire who doesn't define himself as rich, right? And you would say this is ridiculous, but let's think about Lloyd's position. When most of your friends are people like David Geffen, Jeff Bezos, etc., people who have 10, 100x more wealth than you, you're not going to feel rich relative to those people. You're like, I'm not rich. Look at those people, right? They're richer than me. right? And so I think you're going to be like, that's a ridiculous argument, Nick. Well, let's kind of take this logic to its conclusion. If you have $100,000 US, that puts you in the top 10% of the world in terms of global wealth, right? $100,000. So would you say $100,000 is, I would say the top 10% is rich, right? So you might not say $100,000, that's not rich. Like in the United States, that's not rich. Well, because you're doing it relative to the US. I'd say, well, relative to the world, you're rich. And then you're going to say, well, Nick, that's not fair. You can't compare me to random people throughout the world who aren't as rich. You can't compare me to people in the developing world, et cetera, right? And I'm going to argue that's the same argument that Lloyd Blankfein is using when he says he's not rich. He's like, you can't compare me, Lloyd Blankfein, to average people like you, like us. Like we are not the same. We're not in the same social circle as Lloyd Blankfein. So he looks at us like how we might look at someone in the developing world, right? It's the same thing. And you're saying, well, that's not fair. Well, like, it's the same argument. Obviously, his is objectively more outlandish, but it's the same argument. So at the end of the day, the question is like, where do we draw the line on what's rich and what's not? And that it's always a relative thing. And so we can say like, well, maybe I'm rich globally, but I'm not rich in my current local city or something, right? So we can cut it in, what is it? Is it nationally? Is it globally? Is it citywide? Is it your neighborhood? Is it within your zip code? I mean, what's rich really? And so because of that, I think it's very easy to never feel rich, right? And so I think what you have to do to beat this game is to, if you do think you've gotten to a place where you relative to yourself and you're saying relative to my upbringing, what I could have, like, am I rich relative to that? And for example, I identify as rich, even though I'm not a millionaire. I don't have $1 million US. So, but I identify as rich because if I don't do that, I'm going to continually be chasing this thing and never feel like I have enough and all this stuff. And so it's one of those things, like I write about money all the time and almost never think about it. It's very funny. Like I'm always writing about it and stuff and talking to other people about it. But like for my personal finances, I don't spend a lot of time worrying about it. And that's a privilege. I'm not going to lie. That's a privilege. Most Americans do not have that privilege, and I will completely admit that. Most people around the world don't have that privilege, right? And I don't say this like someone who I can't fly private. I don't fly first class. I'm still flying coach, and stuff like that. So I don't have like some exorbitant amount of wealth or anything like that. But I recognize the amount of wealth that I have relative to the world, and that makes me rich. I would say I'm rich in the scheme of the world. And so that's how I identify rich, and you don't have to identify that way, but that's the only way I'll ever feel rich, because otherwise I can keep comparing myself to more and more successful people, and relative to them, I'm not rich, right? And so I can make myself feel poor if I want to, or I can make myself feel rich. And so it's really all about what you do in up here is how you feel rich. It's all in your head.
Yeah. I think defining how much is enough, and also I think having the gratitude, right, of feeling grateful about whatever you have in comparisons to so many other people who are much down compared to you in the financial strata. I think that should give one a perspective about how rich he or she is, right? Almost all the time, we are never grateful about the possessions that we have. I think but as you mentioned, knowing the kind of privilege one has, right? Knowing the kind of rich one has, a richness one has compared to so many other people in the world, a majority of people in the world, I think that should solve in a way that problem of not feeling rich wherever you reach in your financial life. You mentioned about being a data science guy, and you come from economic background. You've worked as a data scientist. You're working as a chief operating officer at Ritholtz Wealth Management now. But tell us about that aspect of your work, which is data, and the unique insights it helps you generate that people not working with data are never able to see. So if you can just give an example or two of any unique insight about the financial markets or how investors behave that data has been able to tell you, I think that would be great.
I think there's some beliefs out there that people think are true, and then in the data, it's not. This is not something I've personally done, but I can give you an example of this. For example, there's always this belief, like during market crashes, like, oh, the retail investor, buys at the top and sells at the bottom, right? That's the narrative we hear a lot. Like the dumb retail investor buys at the top, sells at the bottom. Well, first off, that can't be true. Like if everyone bought at the top and sold at the bottom, like who do they buy from? Who do they sell from, right? There has to be another party. So maybe it's like the smart money or something. We can get into that. But, you actually look at the data, and during the COVID crash, only 11% of Vanguard investors made an active trade. That means 89% did not touch anything. They didn't change what they were doing. They were just kind of doing the same thing they've always done, whether that means buying consistently or not changing any of their allocation. So it goes to show, like, they think all these people are doing this stuff, and there's not that happening. Of course, there are some people that do that, but most people aren't doing that. That's a simple example that you can use that's in the data. Some of the stuff I found, for example, talking about 401ks in the US, I did some analysis and showed like the tax benefit you gain, the annualized tax benefit is about 0.7% a year. So you have an account that's charging you fees above 0.7%, you're getting no tax benefit. There's no point in putting a single dollar above that, because relative to having that money on the outside where it's more flexible, there's more optionality. But on top of that, like, you're going to be paying, if you're paying more than 0.7%, you're actually losing money after the tax alpha, right? So it's like, it's not worth it in that case. So that's another example. I've done tons of stuff on market timing where, like, once you analyze, you're like, what? Even if I tell you when the bottoms are, and we can get into this, even God couldn't be dollar cost averaging idea right now, but even when I tell you when the bottoms are going to happen and you still, like, save up cash and just buy those bottoms, on average, you're buying at a higher average price than if you had just bought every month, which means that you're going to underperform most of the time. So like 80% of the time you end up underperforming, even when I say, okay, you're at the bottom, buy now, like on a monthly level. Like, it's so ridiculous when you think about it. And like, the fact that, like, the reason I could do that is because I can run simulations. I can do things that you can't do in Excel. You can't take Microsoft Excel and do these because they take too long. I mean, you could in theory do them, but you'd have to have so many tabs and all these things. It would just be, the calculations are too large. But with basic programming, you can write a for loop. Basically, it's just, can you do a for loop? And the for loop just loops through things. I can say, give me this 10-year period. Okay, run this simulation of one strategy versus another. Move forward a month, run the same simulation over the next 10 years and keep doing that. And just imagine it like rolling through time, and then summarize all those results of every 10-year period. What happens? What do we expect to happen? And so that's where kind of data and doing data analysis can really kind of come in handy. It's like simulations, and we can test things, back in the past, back test, all that type of stuff, which is really cool.
I think that's one great lesson for people who are waiting to time the market, right? And I think a lot of people actually take it to the second degree, where they actually try to time the dollar cost averaging as well, try to time their SIPs as well, right? Wait for the perfect time where they should be starting their dollar cost averaging in mutual funds or stocks. So I think that's a great lesson. But staying with data, one question, what's the most outlandish or what's the most insightful idea that you ever got by looking at data, which completely changed your perspective? You can think about and tell us something that really changed your perspective about investing or money, one piece of data. So what exactly was that?
I think for me, the biggest shock I had when I was writing the book was the retirement crisis and how it doesn't really exist. And so I talked about earlier, only 1 in 7 retirees are pulling down principal. There was actually this simulation done by Michael Kitces. And basically what he found is, in retirement, let's say you're using the 4% rule. And just a quick reminder for the listeners, 4% rule means whatever your balance is, you just take 4% out, you sell that off, and then you spend that. And you can't spend more than 4%. So it doesn't matter your underlying account balance. Let's just say you had $1 million, just to make the math easy. 4%, you could spend 40 grand. And then the next year you increase that by inflation, like 3%. And then you take out 40,000 plus that extra 3%. So whatever would be $1,200. So 41,200 is what you take out the next year. And you increase it again. You keep doing that. Let's say you run that simulation throughout history, that 30-year period. You are more likely to end up with 4 times your wealth by the end of the 30 years. If you just invested in a 60-40 portfolio, 60% stock, 40% bond, you're more likely to end up with 4 times your wealth than you are to be below your principal value after 30 years. So think about that. If we start with $1 million, we start running in a 60-40 portfolio, run the 4% rule. At the end of 30 years, you're more likely to have 4 million than you are to be under $1 million. So that's like a shocking thing. But what it shows is, like, there's more upside surprises. People think in retirement that they're going to be like run out of money and be poor and all this. At least throughout most of history, everyone who's got into retirement, had a diversified portfolio, has seen their wealth grow. And I think it's the shock is, if you actually look at the data, in retirement spending goes down by about 1% a year as people retire. So if you retire at 65, by 75, you should be 10% lower in your spending. By 85, you'll be 10% lower than that, right? And so if your retirement spending is going down and your wealth's going up, you're just building, like, your income and wealth's going up. It's just kind of a shock to people that they think like, oh, I'm going to go into retirement and run out of money. It's like, no, your wealth's going to keep building probably, and that's the real shock here. And of course, there are exceptions. There are bad decades. If you retired at the peak in 2000, you didn't have a great time because you had 03 decline, and then you had you kind of started to come back, and you had 08, right? So there are, of course, exceptions to this rule, but most people, like, if you didn't, as long as you didn't time it that badly, you got unlucky like that, most people have retired have not been in these dire straits. And so I think the big insight here is that there's upside surprises too. We talk about downside surprises like market crashes, but upside surprises happen just as much, and like people building way more wealth than they could ever imagine. I think that is something that a lot of people are not prepared for, especially if you've been saving for a long time, to switch into spending and seeing your wealth just keep growing despite the fact that you're trying to spend it. I think that shocks more people.
Mm-hmm. I've almost gone through 3/4 of your book, but I think the kind of things that you're talking about in terms of surprises that you see or the insights that you receive by analyzing data. And I think you've put that a lot of that in your book. I just could not wait and really go back and finish your book. I think there's so many insights out there. So, and I have not been a data guy per se, though I look at data broadly, right? But I'm not from field of data science. So I think data provides value, and the kind of insights that one can get by actually looking at hard data, the real data, right? Most of the time we create narratives out of thin air, right? Especially when it comes to investing in stock markets or picking stocks directly. But I think backed by data, backed by solid evidence, that the things that you are doing or the things that you're talking about, I think makes so much sense in a world which is so full of narratives and stories. You've met a lot of, I'm sure you might have a lot of investors in the past many years of being in this market, and also in your research while researching your book, right? How can an investor improve the quality of one's decision making? How have you done that, right? What are the various things that you've done to improve your decision making as an investor?
Yeah, I'd spend a lot of time just figuring out like what are the core principles or beliefs or tenets that you have, and then stick to those. I mean, of all the times that I've made mistakes, it's because I just didn't listen to myself, right? Like I knew I shouldn't have done this thing. Like maybe I just did it for fun and that's fine, not a big deal. But every time I've made an investment mistake has come from the same place. Like I knew I shouldn't have done this. I should have just bought a diversified index fund instead of bought an individual stock, right? And so something like that. So I already know the answers, right? Not because I've been studying for a long enough time and I'm like, this looks like this is the right answer. And like the realm of history shows that. So I would say figure out what you really believe in and then stick to those things and really stick to them, right? Because I think it's tough, or it's easy to, just fall by the way, let those fall by the wayside, forget about them, and then you make mistakes, right? So I think whatever that is, if that means like risk management, if that means, not market timing, don't do those. Even when it looks super, super appealing, you have to kind of control that urge. And so for me, that's kind of the big thing that I've learned is like, find what, do your research, spend some time. You're going to read books, different books on it, different people, different perspectives, and say, what do you think based on everything you've brought in makes the most sense and like seems like it's going to lead to the highest probability of you getting to where you want to go, and follow that path. That's the idea.
So I think following that path is such a sensible, smart advice. The sad part is most people actually fall on the wayside when the markets are moving and when they're seeing others making money faster. So having a process is one thing, but sticking to that process, as you said, I think it's one of the most important things that an investor can do over a period of time. Again, you mentioned about mistakes. So when you look back at your investment mistakes, which has been the most memorable one that led you to a valuable lesson that helped you later become a better investor and investment thinker?
Yeah, and so I think I kind of just got at this, but like the mistake I made, for example, I bought some like altcoins, all cryptocurrencies, right? I got into them because I saw some made 10x on their returns. I'm like, you know what? Like, I'm not going to put a lot of money in there. I didn't even put 1%. I think I put like 1% of my wealth into this. So it's a very, very, very small bet relative to my total investable wealth. Doing things like that, buying individual stocks, vary once against 1% of my wealth into these types of things. And I just they were bets. I made bets on them, and both of them did very badly. And so like, it's not a major mistake. It's not like something that like, I never did anything that would threaten the survival of like my investment portfolio. I've never done anything like that, thankfully. So my mistakes have been small and contained. And I think if you're going to make mistakes, those are the best kind to make, right? Because they're smaller. But why did I make them? I just didn't listen to my own advice. I mean, at the end of the day, I should have just done the thing I knew I've been writing about for years. I remember I write about this stuff. I wrote it in my book, Don't Buy Individual Stocks. And some friends and I said, oh, why don't we do it? It'll be fun. So we did it. I put like 1% of my net worth into an individual stock, and it didn't do as well, or it did really well. And then it crashed, right? So I don't want to name the ticker or anything, but basically that's kind of the idea. It's like those types of things will happen, and you just have to kind of be ready for that and be prepared to fight yourself on that and say like, no, don't do this, stick to the plan, do what you know is right, and just stick to it. Because if it's easy to let that greed come in, like, oh wow, like it'd be cool what if that went up 5x? It'd be kind of cool. It's not going to really change my life. That 1% change is not going to really change my life, but still, it's like kind of a cool thing. So you start thinking like that, and you start seeing 2021 was so crazy with all the valuations going up. I got a little bit of FOMO, and that's where I kind of fell by the wayside, just very, very in a small way, but it still happened.
I think in your book, I read that you mentioned about making mistakes, which is perfectly fine in your investment life. But I think the idea of avoiding big mistakes early in your investing life is such an important thing. So tell us more about that idea. Why do you think that one should aim to avoid big mistakes, especially early in their investing life?
I think avoiding big mistakes is crucial regardless of where you are. I think Actually, I'd say like later. I mean, if you mess up early, like the dollars aren't as big a deal, but if what that compounds to could be big, right? That's where we're kind of getting at, right? The worst time to have an investment mistake is obviously when you have the most wealth, like when you have the most money at stake necessarily, right? So if you have like $1 million portfolio and you make an investment mistake that loses you an extra 20% relative to the market, that's bad because you just lost, an extra 200 grand that you didn't really want to lose, right? If you had $1 million, right? If you have 10 grand, that's only 2,000, but that 2,000 could compound to a lot more later. So I think regardless of where you are, mistakes are the big issue. You just got to be really careful with that. So yeah, I just try to be careful. I mean, there's no way you're going to make mistakes. It's going to happen. Just try to minimize their fallout when they do happen. That's the key. It's like not beating yourself up. It's going to happen. Almost everyone's had a mistake. If you haven't, you probably haven't been investing long enough, right? And just wait. And at some point you might do it, but just ideally they happen younger, and so that you don't have as much at stake. But you never know. So just try and learn from them.
One mistake that most investors, I think, see making, especially early in their life, is that they ignore the idea of risk, right? Because they are young and they are there to prove that they can make it big fast, right? In today's world where we have social media, where so many people seem to be making it fast, making it big fast, right? So people keep risk on the side and then they try to invest, ultimately losing a lot of what they started with. In your experience, how do you think about this idea of risk and how do you employ that in your investing?
So Josh Wolf has this great quote where he says, failure comes from a failure to imagine failure. And really what it is, it's a very broad, risk, strategy. It's saying like, think about every risk that could happen and then try and prepare for those. Of course, you're never going to prepare for everything. No one's going to have, global pandemic on their risk bingo card. No one's going to know that ahead of time. It's very difficult, but you basically want to be able to prepare for anything ideally. And in these scenarios, what would you do? Okay, in this case, what would I do? If I lost my job, what would I do? If I did this, what would I do? If this happened, what would I do? Right? So the more you can prepare and kind of have a portfolio of financial life set up for that, the better off you will be, in my opinion, right? And you don't need to obsess over it to think of every possible risk ever. At some point, you're going to drive yourself crazy. It's just about trying to cover your bases, really. I think that's what's really important. And so when I think about risk, I'm always thinking about like as long as you, the main key here is survival. I think survival is so important in this game because if you ever hit one of these, asymptote ends where you lose a bunch of money really quickly. Like I think an example of this, I knew a guy that created his own cryptocurrency and he actually made enough money. It was in the 2017 bull market, made enough money to pay off his medical school debt. So that was good, right? Plus net positive after selling. And even after it crashed later, he still made enough money to do that. Net positive. Then he made a bunch of money and then he lost a little bit, whatever. And then he put all of it into Luna, which, as you know, had this massive crash, right? But he put it all into Luna, like as it was going up, he was like richer than he's ever been. And then he lost all of it basically. And so he did still pay off his medical school debt. So he did make some money. I think he's net positive over his life, but that's an example of someone who just kept playing that game too long and didn't have proper risk management. And of course he got, at one point on paper, he was richer than he's ever been, very much richer than I am, everything, right? Very, very rich. And yet it all came crashing down because he didn't have proper risk management. And it's unfortunate to see that type of stuff, but you can read stories about that all over Twitter about people who lost money in Luna and things like that and these highly speculative instruments. So I think it's just like, once you've won the game a little bit, cash out a little, lock up some level of lifestyle. You want to let the rest ride, you can, but just have a base, get that safety net there for you. Have an emergency fund, have whatever. You have children, get their college educations, whatever, have some money set aside for that. Pay off your mortgage if you have a house, whatever. Get those things locked in. So even if the rest comes crashing down, you still have like a nice little area to land on, right? And I think a lot of people don't do that. They just keep pushing it and they fall back to zero. So that's an example of thinking about risk.
That's why I think that reminds me of that story of the Russian roulette, the game of Russian roulette, as Taleb has written so much about in his book, right? Where people play that game with a gun on their head, right? And 6 chambers, 5 empty, just 1 bullet in the gun, right? See, the probability of you surviving the first shot is around 83%, right? And a lot of people may want to play that game because it's just like 1 out of 6 times that they're going to die, right? But that one time when it comes, right, in the case of your friend, right, so the probability of surviving is huge. You play the game, keep on playing the game, you keep on making more and more money. But that one chance where you can get killed financially and you become a statistic. So I think that's such an important lesson for every one of us in the investing field to understand that it's a game of luck, right? Even when the probabilities of success are higher, we need to look at the consequences of failure. And I think probably look at risk that way, look at returns adjusted for risk that way. I think probably that should help us survive over a long period of time, right? Just remembering what Buffett said once, that if you want to come first, right, you must first come, or you must first reach, right? So you must first finish the game. So you must learn to survive. And that's a brilliant insight. I think one of the most important and overlooked insight that people have in the field of investing, that all they need to do is survive, right? And I think they should do well over a long period of time. My next question is about the COVID pandemic. What has been your biggest lesson from the pandemic, both in terms of life and how you look at the financial world out there?
I actually think the COVID-19 crash was very rational from an investment perspective. So I asked people on Twitter, what year was crazier in the investment markets, 2020 or 2021? Across the board, almost everyone said 2020. Obviously, the market declined more. There's a lot more uncertainty. I understand that. I actually think the opposite. I think 2021 was a much, much crazier year. And why do I say that? Because 2020 made sense to me. Like, the world economy was stopping. Things were slowing down. Oil, no one's using oil anymore, right? Oil price went negative, right? Which makes sense to me in some weird way if you understand how deliveries work of oil. But like, that all made sense. Like the stock market only going down 33% and then getting back to a high within 6 months didn't really make a ton of sense. I mean, I think it should have dropped more, honestly, but maybe, I don't know. We can debate this, but at least that was kind of rational. Like that decline was rational. I think it should have probably been worse than that. It wasn't, and it came back, right? But 2021 made no sense at all. 2021 was like things like pictures of rocks were selling for $3 million. Like this stuff that just makes no sense. I know that was like in crypto and speculative stocks and all this and all that. Like, I just saw so much stuff where I was like, this is just bonkers, like really bonkers stuff. And now, since November 2021, basically, all of that has come undone. And all these stocks, which were high flyers, are now kind of being obliterated, right? And so that and cryptocurrency, things like that. And like, there's this re-leveling of like, yeah, that was all crazy. Everyone's like kind of waking up from the party. Like, yeah, that was crazy. Right. And so I think that to me taught me a lot. But I mean, the one life lesson I got just from COVID generally is like, I actually worry so much less about money, because imagine being 60 years old. You're in the Italian Alps. You're trying, you're finally living out your retirement, and, God forbid you get struck with this illness. You don't know what it is. You start coughing. Next thing you know, within a week, you're dead. Right. 60 years old. That person probably had a 30-year retirement. Maybe they weren't even on retirement. Maybe they're still going to work hard for another 5 years, retire at 65, and then live out the next 25 years of their life, 25, 30 years in retirement. They didn't get to have that. And it's really unfortunate. So it's like, it's not saying to YOLO and just not care about the future and carpe diem, but it's like, maybe care a little bit more about the present, right? And stop worrying so much about money, because you never know when your day's going to come, when it's going to end, right? I'm supposed to be 65 in 2055-ish roughly. And so it's like, what happens if, there's some disease comes out, another pandemic of some sort hits the world, and I'm 65 and I get hit with it and I die, right? It could happen, of course, right? So it's one of those things where like, I see what happened, and I'm just like, I just try to enjoy the day-to-day more, and I worry less about money and making sure I'm saving enough. And even like, as I was watching this happening, I kind of took some of those ideas and put them into the book. Like, you need to save less than you think. Stop guilt tripping yourself. I want people just to enjoy life more, because it's very easy to get caught up with money and really beat yourself up for it. And so I don't know if you kind of got that message in the book, but I was really trying to give people permission not to beat themselves up mentally, because I saw, like, just imagine doing that for 25 years and then dropping dead at 55 and not even getting to spend all that retirement money you saved. Like, you did all this stuff, you did this thing for decades, got in your head, stressed yourself out, maybe strained your relationships, maybe didn't go to your kids' school recital or something, all this stuff, and then you just drop dead because of some random act of God, so to speak, right? This biological agent that came out and killed you, right? It's a tragedy, really. That's the real tragedy here, in my opinion. And so I'm trying to get people to not be like that. And so that's what the book, obviously the book's about money and finance and things like that, but it's about kind of living a better life, right? The tagline at the top says, act smarter, live richer. And I mean that not just financially.
I think that was a great idea that I got out from your book as well, and I think it's such an important thing, right? We all talk about delaying gratification, right? But the point is that we should not delay everything, right? Life has to be balanced, right? We need to balance our present needs and wants with future, with saving for the future as well. But I think taking the idea of delaying gratification too far, I think, as you mentioned, COVID taught us a lesson that we should stop worrying a lot about money. Though we need to save and invest judiciously, but we need to stop beating ourselves up if we are not able to save enough, whatever the numbers are telling, or whatever the Excel models or financial advisors are telling us, right? We need to still enjoy the present. I think that is a great advice to a lot of people starting out in their careers, that you need to enjoy life as well while taking care of the future, and not really beat yourself up by the idea of delaying gratification and completely. So I think that's a wonderful advice. My next question is about your advice for youngsters, right? So in a world where the pace of change is just multiplying, even as our formal education system seems insufficient to teach all that is required to thrive, what advice would you offer to students and young adults in self-educating themselves? And what are some of the key work and life skills they must learn and hone to do well in the years ahead?
Yeah. So, I mean, I'm a big believer in programming. And now I don't think everyone needs to be a programmer. I think that's foolish to say that. I think if you're into it, you should double down on it, because I think we're going to be using more computers, more technology. So whatever you do, try to make sure you have some tech literacy. I think that's going to be important regardless. But if I had to give a general framework for thinking about this, imagine there's three kind of circles. There's the first circle is like, what are you good at? Like, find your strengths, know what you're good at. Of course, it's not easy to know, especially if you're 16, 17, 18, whatever, but you'll figure it out over time. You're going to know, oh, am I really good with like languages and writing, or am I good with like, mathematics? Am I good with science? Am I good? Figure out where you're good, and, and dig into those, like really build on your strengths. You can't build on weakness. You can spend a lot of time doing that to try to get better, and you will get better, but you have to find your strengths and build on those, right? Mine happens to be data analysis. Yours could be something else, whatever. So that's your thing. Find your strengths, right? Find what you enjoy. Those might be different. I hope ideally some of those strengths are some things you enjoy. Ideally you like it, or maybe you enjoy it because the strengths are good enough such that you get admiration for those things, and then you enjoy the admiration, which could be good as well. For example, I don't love writing necessarily, but because I get some positive reactions, very positive reactions from some of the things I write, I love that admiration. And so I started liking the writing because of how I can help people and how the impact I feel like I'm making on, it doesn't have to be a lot of people, just a few people. And that's enough, right, for me. So what are you good at? What do you enjoy? And then what does the market pay for? And then find the intersection of those three things, right? If you can find that intersection, you're going to do really well, right? And so in my case, like, people are willing to pay for writing, not a ton. I mean, my book's like $17, whatever it is in the United States. I don't know what it is in other places, but it's not a ton of money. But like, find what people are willing to pay for. They'll pay for writing. They'll pay for writing advice, things like that. Are you good at it? In my case, it's like data analysis and a little bit of writing stuff. And what do you enjoy? I love data analysis. I love writing. So I'm starting to love writing. So it's kind of those things. So figure out what those things are, and kind of just and double down on those. So.
That's great advice. Talking about habits, we all creatures of habits, and that's what generally makes us whatever we become in life. What's the most important habit, or the best habit according to you, that has most positively impacted your life in the past few years?
Mine has nothing to do with finance at all. It's all health related. It's just like working out, having a workout routine, going to the gym, lifting weights. I think for me has just been very, very helpful in terms of just like progression, all sorts of confidence things, and just for health reasons too. Like, just knowing that, like, hey, I'm out there, I'm still doing this thing, and it's not something I talk about a ton, but it's something that's really added a lot of value for me. And I think, once again, this is backed by data. Once again, it's like, if you look at the data, they did some study, at least this is with men. I don't know if it's true for women. I'm guessing it's probably true to some extent for women as well, but they found that men that could do 40 push-ups, like at over age 40 and above, if you can do 40 push-ups in a row, your chance of dying from like cardiovascular disease, cancer, all this stuff drops by like 90 something percent. It's like insane how different it is, right? Just like having some sort of physical strength. I'm not saying you need to be a bodybuilder and be out there doing nothing like that. Like, I wouldn't consider myself a bodybuilder, but I would just make sure I keep my muscle mass up as much as I can and just keep my strength up. I think that's important. So just thinking about that and how that's going to impact your life and health, and really focus on it. Because at the end of the day, if you don't have your health, you don't have anything. It's also kind of back to that COVID-19 discussion, right? If you lose your health, everything else it's the pillar over whichever. If you feel bad, I don't care how much money you have in the world, the best friends, whatever. If you feel terrible day to day, or you're going through a debilitating disease, it's going to feel bad, right? And so I think all of us eventually at some point, our bodies give out, no matter 80, 90, 100, whatever, we're going to get there eventually. But doing what you can to delay that onset as much as possible, that's kind of the key here. So just keep moving, keep exercising, things like that. That's probably the biggest that's the biggest value I can add to your life, beyond all the money stuff, which is great in its own right.
Is there any other data that tells you why staying healthy is such an important idea?
Yeah. I think the person I look to on this, like the person that I just completely like idolize in this space is Peter Attia, and he's done a lot on longevity and health span and lifespan and thinking about that. So I would recommend just consuming a lot of his content to understand what he thinks about it, because his way of looking at these things, and he has data on he's like a data junkie. Like he literally has a glucose monitor in his arm. So every time he eats, he knows exactly how his glucose responds, right? That's usually something that for diabetic stuff, he's very healthy. He doesn't need it, but he loves to get that data, and he has it on his patients so he can understand how, when they eat, how it affects their body. Like certain foods are going to affect you more than others. So just having that data, I don't have one of those. I've thought about doing it, but I don't want to have a glucose monitor in my arm the whole time. But it's one of those things where I would love to see, like, how does this impact my life and everything. Maybe at one point I will get one, but it's one of the things where just like being in tune with, a lot of his stuff, I think it's really helped me a lot in terms of thinking about longevity and thinking about like health span and stuff like that. And so, yeah, I would recommend him definitely to check out.
I have a question, since we talked about numbers and data, right? I have just a quick question on the other side of data, right? So while it's very important to measure if you want to improve something, right? Have you ever felt that getting surrounded yourself with data or making decisions based on data has also led you to too much of analysis paralysis? And for example, you talked about Dr. P.T. Attia's idea of having that glucose monitor and measuring each and every food item and to the level it raises the glucose level in the body, right? But according to you, have you ever thought about the other side of too much data probably leading us to over-examining our daily life?
Yeah, I think anytime you have data that could possibly lead to stress where the impact's marginal, like we don't know, like for example, we don't know with certainty whether like eating rice, for example, is good for you or bad for you. And of course, everything matters on dosage and what else you're eating. There's a lot of stuff, but it's like if you try and say, is rice a good food or a bad food, and you overanalyze that, when the data is not clear is the only time when data I think is bad, when it's like really not clear. I think a lot of stuff, especially in nutrition, the data is not clear. There's only a handful of exceptions to this rule. I think like anytime you're eating a very high sugar diet that doesn't have a lot of fiber, so not just like sugary drinks, things like that, I think that's bad. Outside of that, I don't think it's much harder to say what's good and what's bad, right? And so you can sit there and say, oh, do I have this thing with rice, or is rice bad for me? Or, oh, maybe I should just have broccoli. And so you can beat yourself up, and that's where data can mess with you, and you're going to be in these like spaces where you're mentally, every time you even go to eat, you have anxiety. Like, I want people to get out of those spaces and say like, hey, we don't have data to say what's definitive here. We don't really know, to be honest with you. And because of that, like we should only like make decisions where the data is pretty clear cut. For example, in my case, market timing, like there's an 80% chance it's better for you to get invested today than it is for you to like average in over the course of the next year, right? So if you have like, let's say $120,000, it's better to put the 120 to work now than it is to put 10 grand a month for the next 12 months, right? And that's just the data, because the probabilities are on my side. Of course, at this time could be different. You could be in the 20% chance and lose out, whatever it happens. But I generally think like you have to go where the data points you. And when the data is inconclusive, we say, okay, let's ignore the data, or let's just wait until we find something conclusive. Because if we can't find anything conclusive, I think we shouldn't stress over it. So that's the case. The only time where data is actually bad is when I think you can't draw a real conclusion from it, and then you end up stressing yourself out over basically nothing, right? So I think a lot of times we do that about what's good and what's bad, and especially with diet, nutrition, and things like that, where it's just not sure. People aren't sure yet, because there's people on one side saying one thing and people on the other side saying another thing, and they both have some sort of data that shows this, and it's like, well, then who's right? We don't know, right? Then it's obviously inconclusive. It's not like, as I said, smoking, it's pretty clear cut. Like the data, everyone across the board is like, yep, this data is right. Like there's the effect size is large, right? When effect sizes aren't large, you don't want to like spend too much time worrying about it.
Great. So Nick, we're nearing the end of the conversation. I have just 3 more questions for you. And the first question is about your favorite investing and non-investing books that you highly advise people to read.
Yeah, investing stuff. I love things by William Bernstein. I think he's probably my favorite intelligent asset allocator, but it's much more technical investing type things, deeper investment ideas. I'm really into that. I'm just going to put that out there, but that's probably the one person I put out there. Of course, everyone's heard of Buffett, Bogle. You can name other people out there as well. Jason Zweig, Morgan Housel, Vicky Robin, Your Money, Your Life. That was a great one. Crossover rule, thinking about those types of things. There's a bunch I can put out there. I think for the non-investing books, I just recommend just anything with good stories. There's one called Deep Survival. That's a great book. That's just like really good stories, understanding how people survive in situations. I think there are applications to investing. I'm trying to think. There's just so many books out there. It really, if you go by topic, it's much easier. And I actually have a book page where I kind of recommend these things. I think you can just contact me if you're ever interested in learning more about the books I like and stuff. Just contact me on Twitter. My DMs are open. I try to answer everyone. I'll just literally send you a link, and I'll have it broken out by like category and stuff like that. So I can just send you a link to that, and you can just look at whatever you want and see what I like. So
Great enough. That I think that'll be great. So, next question: what's the single best piece of advice you ever got, and the single worst piece of advice you ever got? It could be financial, non-financial.
I think the best, I'm trying to think, there's a lot of really good advice I've gotten. I want to try and give advice I think is unique or different. So I don't think this may necessarily be the best, but it's the best considering I haven't heard someone say this before. But one of my mentors in college, who's technically my economics advisor, said, there's no substitute for thinking. And I know that sounds like kind of, what does that mean? But it's like, there's a lot of times in life where people are just kind of just do things because they see other people do them, and they never question, is that actually right? And I think what I tried to do in Just Keep Buying was saying, okay, let's go back to the first principles and say, is this correct? Is there a retirement crisis? Is maxing out your 401k good? Is market timing okay? Is buying the dip right? And I go through all these questions, and they're all just questions, right? And I say, like, is this actually true? And I think if you start going into it and really thinking about that as an ideology, like there's no substitute for thinking, is like the core piece of that, right? And that's where data comes into back that. So I think that's probably the best advice I've gotten. Worst advice I've gotten, I think it's probably more of a personal thing. I was dating someone a couple years ago at the time who was not a good fit for me. And I remember I was talking to a friend about it, and he's like, yeah, I know they're not he's like, but like, can you do any better than that though? Right. He was like trying to say like, maybe that's like the best you're going to get. Like he was kind of saying that. And I was thinking about this, and that was terrible advice at the time. It was terrible. I've now had much better dating experiences since. And I think he was basically saying, oh, you should just settle because like this person's, very attractive or whatever it was at the time. Right. And there's more to attraction than just physical looks and things like that. But it was just a very interesting thing where I was getting advice from someone, and this person had been married to the same person, so they weren't even really like qualified to give us advice. But like I almost listened to it, but at some point I stopped and I realized like that was terrible advice. I'm so glad I did not listen to that in the long run, because I'm much better off now. So that's the worst advice I got, I guess.
Do you plan to use data to look for your life partner as well?
I've already. Oh gosh, we could. How many hours do you have? Because I could get into that whole thing as well. That's actually, if I didn't write about investing, I think the next thing I'd write about would be dating. Not like my personal dating life, but I think there's a lot of really good data out there on this stuff. Hinge had a blog that talked about this. OkCupid had a blog that talked about this. If you're interested in that market, 2 books I recommend, or 3. How Not to Die Alone. I think it's Logan Uri. I think that's her name. Dataclysm, that's Christian Rudder, who wrote who founded OkCupid, and then Date-onomics. That's another great one. So those 3 I think it's John Berger who wrote that one. Those are the 3 I'd recommend. Those are really good dating books. So check those out. Also, Don't Trust Your Gut by Seth Stevens-Davidowitz. He just came out. That's a new book that just came out, but he talks about money and a bunch of other stuff, but Don't Trust Your Gut actually does have a big relationship piece in there, which is pretty cool. So I'll leave that. There's a little surprise in there. I don't want to give it up, but that's it. So yeah. So I don't try to use data for that type of stuff, but like there are times when data can definitely be helpful. So I'll leave it at that, because I literally could talk about this for like 2 hours, and we're not going to, but yes.
So here's my closing question. Everyone walks on their own journey of life, and everyone must play their parts well. But what, according to you, is a life well lived?
I think a life well lived is a life where you chose what you wanted. You didn't do things just because other people told you to do them, and you were trying to fit into some mold and doing this and that. I think at the end of the day, it doesn't mean that you can't have responsibilities. You're not just going to you're going to be completely selfish and only do things for yourself. No, you have to sometimes do things for family, support others. Of course that happens, but it's really just making sure like it's a life that you chose and you weren't forced into doing something else. And sometimes there's people out there where their circumstances don't allow for that. And it's really unfortunate that certain people you have to work this job where you don't love it. You don't like doing all this stuff because you just don't have resources to get out of it. I think that's really the biggest human tragedy happening right now. And so the more we can do to hopefully fix that and allow people to have more choice over what they want to do with their lives, I think that's it. But at the end of the day, then the real trouble then in life, or the real challenge in life, is figuring out what do you want. And I think this is a question that goes back to Greek philosophers, right? Saying, know thyself and figure yourself out and figure out what you want out of life. And I say this in the book, like, if you want to live the best life, you have to figure out first, what do you want out of life? I think that's the real challenge here. So, once you know, try and live it best you can. That's what I think a life well lived is living the life that you want and choosing your path and not letting someone else dictate it for you.
I think choosing your path, I think that's one great insight that you've left the audience with. Thank you so much, Nick, for your time. And thank you for writing a wonderful book. I'm sure it provides a lot of insights. It's going to provide a lot of insights to the readers. I found it very insightful as well. So thank you so much for everything.
I appreciate it. Thank you, Vishal. Thanks for having me on.
Thanks, Nick. Take care.